There is an asset out there that only 1 in 5 Americans are using. It offers up to 4% return, and there is absolutely zero risk. Why then are more Americans not taking advantage of this type of asset? In most instances, risk and reward are associated. The higher the risk, the higher the reward. This asset is presenting an opportunity with zero risk and up to 4% return, which is about half of what the general stock market returns every single year. So again, why are so few Americans using this asset? I personally believe it is because this type of asset has gotten a bad name due to cryptocurrency. With that said, the current version of this asset is FDIC insured and has absolutely nothing to do with cryptocurrency, and that is what we're going to talk about here today. We are talking about the high yield savings account. This account differs from a regular savings account that most banks offer. Most banks use their name and their name only to attract customers. Bank of America or Chase, for example. You will not find high yield savings accounts at these banks because they are attracting customers with their name alone. Other banks must incentivize users in some way. One of the ways to do this is with a high yield savings account. This doesn't mean that if you invest in a high yield savings account that you'll be putting your money with sketchy institutions. Almost all high yield savings accounts are FDIC insured, which means that your money is protected by the US government up to $250,000 per account. So then why aren't more Americans taking advantage of this asset even though it has rates similar to certificate of deposits, yet a certificate of deposit or a CD has a fixed time that you have to leave your money in for. If not, you get penalized. Personally, I believe it is because these types of accounts are similar to accounts that we found in cryptocurrency before the crash. Cryptocurrency accounts offered something similar. These accounts resembled savings accounts, but in reality, they were lending accounts where you would lend your money to an exchange and that exchange would then promise you rates up to 8, 9, 10%. With the big cryptocurrency crash, followed by the FTX bankruptcy, followed by problems with Gemini Earn, I think a lot of people associate high yield savings with risk. While this is the case in most instances, risk does equal reward, there are times where that is not the case. Usually it is times when the interest rates are high. We are not living in a normal time period. We are living in a time where the federal government is trying to suppress inflation. It is doing so by increasing interest rates. When interest rates increase, they increase across the board, which means that banks can also offer you a higher return on your money when you lend it to the bank. Because remember, when you deposit your money with a bank, you are in essence lending your money to the bank who then lends it to other people. Most big banks like Bank of America, like Chase, rely on their name alone to attract you with their reputation of security. They then go and lend your money to people who are buying houses and buying cars and charge them 5%, 6%, sometimes on cars even more, yet your account only gets 0.25% return. Some banks are starting to change that, which only seems fair. If the bank is making 5% on your money, shouldn't you be getting a larger cut of that instead of 0.25% or less? That is what a high yield savings account aims to solve. Now, who offers these types of accounts? Are they sketchy institutions? Well, in fact, no, they're not. The one that I recommend, the link is in the description below, is actually Goldman Sachs. Now, put aside for a second whether we agree with Goldman Sachs practices or not, they are a reputable institution. They offer a high yield savings account that is pushing 4% return, and it is FDIC insured just like any other savings account. That means that you, the consumer, have to do absolutely nothing different than you are already doing except move your money to a high yield savings account. You will still have access to that money. You will still be able to move and transfer that money. There are no fixed times that you have to leave that money in that account. Yet, every year, you will be getting close to 4% return instead of the measly pennies that you are getting with your current savings account. Now, the numbers get crazy the more money that you have in your account. If you have $1 million in a high yield savings account, you will be making $40,000 a year for doing nothing. If you have 100,000, you will be making $4,000 a year for doing nothing. Now, wait. I know what you're saying. I don't have $100,000. I have $10,000. I have $5,000. There is no minimum deposit for a lot of these accounts. And if you're going to have your money sit somewhere, even if it's just $5,000 or $10,000, shouldn't it be sitting somewhere that is making you an active return? Isn't that the whole goal of good quality personal finance? It's to make you a return on your money while you sleep. If you have $1 million, that's $40,000 a year. If you have $10,000, that's still $400 a year that you wouldn't have otherwise if you left your money in a regular savings account. And if for nothing else, it should be on principle alone. Why should the banks be making money on your money without giving you anything in return? Maybe it made sense before when people were not as financially educated. But we live in a day and age where the internet gives us all access to the same information. That information is powerful and it changes the world. Use that information to change your life and use that information to hold big institutions accountable for your money. A bank gets $1 billion of deposits and then lends that money out and makes tens of millions of dollars every single year without paying their users that they got the money from anything in return. Does not make sense anymore. Hey everyone, hope you're enjoying the video. Real quick, it would mean the world to me if you haven't already to hit the subscribe button and the bell notification. It is my goal here to provide the very best personal finance, entrepreneurship, and online business content. These are subjects that I hold near and dear to my heart, and I love to share that with all of you. So again, if you haven't, please hit that subscribe button. It's absolutely free. Hope you're enjoying the video. Let's get right back into it. So what are some things that you should know about a high yield savings account? The first one is risk. Is there risk associated? While there's risk associated with anything, a high yield savings account falls in the lowest bracket of risk for a couple of reasons. One, your money is deposited at a reputable institution like Goldman Sachs and like a few others. Two, it is FDIC insured by the federal government. That means that if anything goes wrong, the federal government will step in up to $250,000 per bank, per user, to reimburse you for your losses. This is the same insurance and guarantee and protection that you get at any other savings account. So if you feel comfortable leaving your money at Chase or Bank of America, you should also feel comfortable leaving your money at a reputable institution that is still FDIC insured. Now, what about high yield savings account versus bonds? Bonds do offer a higher level of return as well as the potential for appreciation with still very little risk. So why not put your money in bonds? Oh, trust me, I believe that bonds make a very important part of a diversified portfolio. With that said, most experts will say that you should have at least 6 months, in my opinion it should be longer, of cash reserves to cover daily expenses in a worst case scenario. For the average person, that can be anywhere from $10,000 to $30,000 that we should have set aside for a rainy day. That money needs to be easily accessible. While you can buy and sell bonds, the only way to guarantee that your money will return to you plus the interest paid is to wait until the maturity date of the bond. That can be as little as 3 months all the way to multiple years. So a high yield savings account pushes the interest rate very close to a bond without any sort of lock-in period. The other question I get asked is why not put it in a certificate of deposit? Again, very safe. Again, high returns. The problem again is that there is a fixed time that you have to wait to withdraw your money. If you withdraw your money before that, you are penalized by the bank. A high yield savings account does not have that problem. We also need to understand that it is because of the day and age that we live in this high interest rate environment. Most of the time, bonds and certificate of deposits will give you a higher yield. But currently, because of the environment that we live in, you are missing out a huge opportunity if you do not have at least your reserve funds in a high yield savings account. Now, the major downside between a HYSA and say bonds is that bonds still have the ability to appreciate, especially in a high interest rate environment. As inflation comes down and Feds cut rates, bonds should go up in value. Keyword, should. High yield savings accounts have no way to appreciate except in the interest rate that they are paying you. Now, a couple more things to note. The first one is that these rates can change at any time, and they most likely will. So this is an opportunity that will not last a lifetime. This is an opportunity that may last a year, 2 years, 3 years. But as inflation comes down and as the federal government cuts their lending rate, naturally the banks will have to cut the rate that they give you. Why? Because they are also getting less money on the money that you deposit. If rates come down, they have to cut rates to mortgage borrowers and car loan borrowers, which means that they cannot offer you the same high rate. But right now, in this environment, high yield savings accounts are an asset that can make up a well-rounded portfolio. As we know in personal finance, a well-rounded portfolio is your financial life. It is your baby and you have to take care of it. Stocks, bonds, heavy metals, speculative assets, and in some cases, alternative assets. I would consider this an alternative asset, can make up your portfolio in a wise way. Now, this opportunity will not last forever, but right now it does exist. Now, I've left a list of the best high yield savings accounts in the description below. I think the best one right now is Marcus by Goldman Sachs, but there are a couple of others. The other thing that I would like to say is just to make sure that if you use a high yield savings account, that whatever bank you go with is FDIC insured, and also make sure that the rates that they are paying you are close to the top. Right now, at the time of this filming, those rates should be 3.5% and higher. As some of you may know, this video is part of a series. We have covered and we will continue to cover stocks, bonds, cryptocurrency, high yield savings accounts, as well as other alternative investments to make up a good quality portfolio. If you haven't already, I encourage you to hit the subscribe button and turn the bell notification on. It doesn't cost you a thing, and you will be notified next time we release the next video in this series. My name is Derek, and I got my degree in finance, so you don't have to. I love sharing all this information with you guys. I can't wait to see you in the next video. In the meantime, please feel free to follow my social medias. I'm very active on Instagram, and of course, hit that subscribe button if you haven't already. My goal is to put out the best and most informative personal finance content on the planet. I've been an entrepreneur for over a decade. I love this stuff. I'm very passionate about it. And I think that if you're going to learn, you have to have fun. So it'll always be my goal here to have fun, to make this exciting, to make it fun, because you can't learn if you don't have fun. So again, my name is Derek, and I will see you in the next video.